Welcome to the Deep Dive. We take complex information like earnings calls and, we pull out the key nuggets for you.
Exactly. Make it easy to understand what's going on.
Today, we're digging into a major apparel retailer's recent call, their first quarter of fiscal 2025.
Yep. And our mission, as always, is to extract the most important insights, the key numbers, straight from what the company shared.
So you can get a quick handle on where the business stands and, where it might be heading.
Especially in, let's face it, a pretty dynamic environment right now.
All right, let's jump right in. The headline performance for the quarter they just finished. The big picture seems positive.
Definitely. They delivered their fifth straight quarter of positive comparable sales growth. That's right. Well, that's building some real momentum.
Fifth consecutive. That's consistency.
And you see that flow through. They expanded both gross margin and operating margin.
So more profit left after making the close and after paying the bills like rent and salaries.
Precisely. It suggests they're getting more efficient. And earnings per share saw a really significant jump, up 24% year over year to 51 cents.
Okay, pretty solid numbers. And beyond the financials, they talked about market position too, right?
They did. This was their ninth consecutive quarter gaining market share at apparel.
Ninth. Wow. That says something about how they're executing versus the competition.
Yeah, and they cemented their position as the #1 apparel e-commerce business in the U.S. Digital keeps growing as a part of their mix.
And financially, they ended the quarter strong, cash-wise.
Very strong. Ended with about $2.2 billion in cash. That's up 28% from last year. Gives them a lot of flexibility.
So management's take on all this is basically, look, our strategy is working.
That's the narrative.
Yeah.
They framed it as proof that the approach they've been refining is gaining real traction and delivering, tangible results, not just talk.
Interesting. But it's not uniform across all their brands, is it?
No, not at all. And they were pretty clear about that. Each brand is kind of on its own revitalization path at different stages.
Okay, let's break that down then. Starting with the biggest one, Old Navy. Still #1 specialty apparel brand in the U.S.?
That's what they underscored, yeah. #1 brand and retailer. And performance was solid.
What were the numbers there?
Old Navy had a 3% comparable sales increase. And importantly, that marked its 9th straight quarter of gaining market share too.
9th for Old Navy as well. Okay.
Yeah.
What categories were driving that?
Management pointed specifically to active and denim as key strengths.
Any examples?
Yeah, they mentioned their Studio Smooth Active collection actually did better than they expected. And they're pushing active hard with a new campaign, Old Navy New Moves, which they say is resonating well.
And denim.
Gained share there, too. They're now the #4 adult denim brand in the U.S., apparently. Seeing strength in those trendier styles like loose fits, barrel fits, shows they're adapting.
Mm-hmm.
They also called out a new occasion dress collection, said it was based on customer insights, used design expertise, and sold through well at full price.
Meaning fewer discounts needed.
Exactly. And it wasn't just adult stuff. Kids and baby grew, and they have a new Disney partnerships coming up.
Sounds like a lot going on. What about the store experience? Any tech involved?
Yeah, they're investing there. Rolling out AI-powered RFID.
Okay, break that down. RFID tracks inventory. AI helps use that data smarter.
Right. Better stock accuracy, knowing what's where in real time, means less searching for sizes for customers, better availability, smarter operations overall.
And they're planning a big new store too.
A next-gen flagship in New York City, planned for 2026. So even though they're facing a tough comparison, in Q2, last year's Q2 was strong, they feel Old Navy is positioned well.
And gaining share across different income levels.
Yeah, they specifically noted gains across all income cohorts, top and bottom.
Okay, let's shift to Gap. That brand had a particularly good quarter, didn't it?
It really stood out. 5% comparable sales increase. That's Gap's 6th positive comp quarter in a row.
An 8th quarter of market share gains for Gap. Real momentum there.
Absolutely. Driven by continued strength in women's categories, and they're still strong in denim, hitting those on-trend styles that are working elsewhere too.
What were the specific drivers they mentioned for Gap?
Well, the Feels Like Gap campaign, using music, featuring people like Parker Posey trying to build that cultural connection.
I've seen some of that.
And they're improving the denim experience in key stores based on learnings from their Flatiron store. Plus, those core essentials, fleece, sweaters, sleepwear, are still performing, which hints at loyalty.
What about those collaborations? They seem to be doing a lot of those.
Yeah, and they seem key to driving relevance and bringing in new people. Things like Harlem's Fashion Row, Doan, and that new Gap Studio collection by Zach Posen generated, get this, over 1.3 billion impressions.
billion. Wow, that's huge reach. Did it sell?
Apparently sold well at full price too. Suggests they can push design boundaries and maybe test higher prices successfully.
And it helps sell the regular stuff too.
That's what they claim. They mentioned strong attachment rates, like 25% of people buying a collab piece also put core Gap items in their basket.
Interesting. So it's not just hype.
Seems not. They feel they're bridging the generation gap, attracting new folks and keeping loyal customers happy, and gaining share in top and middle income groups.
Okay, so Old Navy solid, Gap strong.
Yeah.
What about Banana Republic?
Banana Republic's comps were flat for the quarter, 0% change.
Flat, so not growing but not shrinking either.
Right. And management positioned this as, part of the journey. They're focused on reestablishing it as a proper premium brand, and that takes time. It's a multi-year thing.
Are there signs of progress underneath that flat number?
They talked about improving fundamentals. Yeah. Said the new pricing structure, getting those premium prices right, is starting to work. Men's is doing okay. And women's is seeing better trends in categories like coats, skirts, pants.
Plus some green shoots.
Seems so. They're also trying to align design better across men's and women's for a more cohesive feel. And the marketing is all about storytelling travel, adventure, using social media influencers effectively.
Like that White Lotus collaboration? Was that mentioned?
It was. Highlighted as a key example. Generated over 3 billion impressions. Brought in new customers, but apparently stayed true to the brand's core aesthetic.
3 billion! Even bigger than the Gap one.
Yeah. So management sees these as positive signs. Foundation strengthening, customer engagement improving, even if the top-line comp isn't showing growth just yet.
Okay, that leaves Athleta. What was the story there? Sounded like more of a challenge.
It definitely is. Management was upfront about it. Comparable sales were down 8% in Q1.
Ouch. Down 8%.
Yeah. And they expect the year to be, quote, choppy as they work to reset the brand.
What went wrong, according to them?
They described it as an over-rotation. Basically, they chased new trend-focused customers too aggressively.
And forgot about their base.
Essentially, yes. While they brought in some new people, they didn't have enough compelling product for their large existing customer base. So a product disconnect hurt the overall numbers.
How are they fixing it?
Investing in design talent, actively working to rebalance the product mix, finding that sweet spot between fashion, function, and relevance for their core customer.
But it'll take time.
They stress that. More work needed. But they still believe Athleta, as a purpose-driven women's brand, has a really valuable place in the portfolio and the market.
Okay, so that's the brand-by-brand picture. Stepping back, what about the underlying strategy? Technology came up, right?
Big time. Strengthening the operational platform through tech is a key priority.
What kind of tech?
Goal is a human-centered, digitally enabled organization. So better inventory management, digital product creation tools, using AI for customer and employee experiences, boosting e-commerce insights and loyalty programs, getting products to market faster and more localized. And that RFID rollout we talked about.
Using that big cash balance to invest.
Exactly. They framed it as being able to go on offense with these long-term capability investments, not just playing defense because they have the balance sheet strength.
Makes sense. They also mentioned culture.
Yeah, described it as a superpower, characterized by creativity, resilience.
A bit corporate speaky, maybe.
Maybe a little, but the point they were making is that they believe this strong culture leads to a more united, focused team, which then drives those better business results we're seeing, especially at Old Navy and Gap.
Okay, now let's talk about something looming: large tariffs. That was addressed, I assume.
Oh yeah, definitely top of mind, as they put it. They discussed how they're planning to navigate that potential impact.
What's the approach? Just raise prices?
They want to avoid compromising long-term strategy or customer value. So the focus is on mitigation plans.
Like what?
A big part is their supply chain diversification, which they stressed isn't new. It's been underway for years. Shows agility.
Moving production out of China, for example. Significantly. China is now under 10% of their sourcing for 2024, and they expect it to be under 3% by the end of 2025.
Under 3%. That's a huge shift. Where is it going?
They aim for no single country to be over 25% by end of 2026. Currently, Vietnam and Indonesia have larger shares, 27% and 19% respectively last year.
Diversifying risk.
Exactly. And it includes nearshoring and domestic investment too. They plan to double sourcing of American-grown cotton in 2026. They tied that back to the fact that over 90% of sales and most of their workforce are U.S.-based.
Okay, so they're shifting things around. What's the estimated hit from tariffs? based on current policies.
They gave some numbers. Gross potential cost, $250 million to $300 million for the fiscal year.
That sounds like a lot.
It does. But they immediately followed up saying they already have mitigation strategies in place. Sourcing adjustments, manufacturing changes, assortment tweaks that they expect will offset more than half of that gross impact.
Okay, so cutting it down significantly, what's the bottom line net impact they're guiding to? The remaining net hit is estimated at $100 million to $150 million to fiscal 2025 operating income.
$100 to $150 million. Still meaningful. When does that hit?
Primarily weighted to the second half of the fiscal year.
Got it. And they stress this is just an estimate for now.
Very much so. An early view. Policy is dynamic. Things could change. They'll keep reassessing and looking for more ways to soften the blow. They also mentioned tightening up inventory buys for the back half just to stay flexible.
Right, hedging their bets on demand. Okay, let's look at the overall financial health and outlook again, that strong balance sheet.
$2.2 billion cash gives them flexibility. On capital return, they gave back about $131 million to shareholders in Q1 dividends and buybacks.
Buying back stock.
Yeah, about $70 million worth. They still have $331 million authorized for more buybacks. The goal, they said, is mainly to offset dilution from things like employee stock programs. Board also approved the Q2 dividend.
And the outlook for the full year, did they change that, excluding tariffs?
No, they reaffirmed the underlying outlook. Still expect net sales up 1% to 2% year over year for fiscal 2025.
And margins.
Still expect slight expansion in the underlying gross margin from leveraging fixed costs like rent and also better merchandise margins.
And operating expenses, SG&A.
Also expect slight leverage there for the full year, driven by about $150 million in cost savings, though some gets reinvested or eaten by inflation.
So putting that together, underlying operating income growth is still
reaffirmed in the 8% to 10% range for the full year. But remember, that's before accounting for that potential $100 to $150 million net tariff impact.
Right. Important caveat. What about the current quarter, Q2? Any specific guidance?
Yeah, they expect minimal tariff impact in Q2 itself. Net sales projected roughly flat compared to last year. That includes about a 1-point drag because they're lapping a benefit from a credit card deal they had last year.
Okay, so underlying might be slightly better than flat. Gross margin for Q2.
Expected to be similar to Q1's level, which means down year over year, again, mostly because of lapping that credit card benefit.
Makes sense. SG&A costs in Q2.
Plan to leverage slightly year over year.
Okay. Did they give any longer-term vision?
Briefly touched on it. A potential model aiming for low to mid single-digit sales growth, combined with high single-digit operating margin growth, plus cash return to shareholders. That's the long-term value creation story.
All right, let's try to pull all this together for you, the listener. What's the main takeaway from this call?
I think the clearest message is that their core strategy, it seems to be genuinely working for the two big engines, Old Navy and Gap. They're gaining share, driving growth, improving profitability there.
Banana Republic is, well, it's a work in progress, showing some positive signs beneath the surface as they aim for that premium positioning.
Right. And Athleta is clearly the main challenge right now. They know it. They're working on the product fix, but expect continued choppiness there this year.
What really stood out to me was their focus on controlling the controllables.
Exactly. Driving execution brand by brand, managing costs, investing in tech, and proactively managing that big external risk tariffs through years of supply chain diversification.
So even with all the uncertainty out there, they're trying to steer the ship effectively.
Yeah, the areas of strength they kept highlighting were that brand momentum in the core, their e-commerce leadership, tech adoption, that strong balance sheet, and the supply chain resilience they've built.
So for you listening, why does this matter? It's a real-world case study, isn't it?
It really is. Shows how a big retailer tries to navigate complex issues, changing tastes, global trade wars, getting the product right, and how focused execution can make a difference, even when the environment's tough.
Okay, let's switch gears. Time for our This Is Not Financial Advice segment.
Absolutely purely illustrative, hypothetical scenarios based only on what we heard in the call. Do not take these as investment advice. Just thought experiments. Please do your own research.
Okay, first idea, maybe a bit contrarian, like you said, go long Athleta.
Whoa, bold. After down 8% comps.
Hear me out. Yes, down 8%. Yes, choppy outlook. Yes, over-rotation issues acknowledged. The market has likely priced in a slow, maybe painful turnaround, right?
Probably fair to say expectations are low.
BUT. What if that investment in design, that rebalancing of the assortment for the core customer? What if it clicks faster than expected? What if that loyal base responds really quickly later this year or early next? Fixing the portfolio's biggest weak spot could offer significant upside compared to those low expectations. It's a bet on accelerated execution against a known problem. High risk, obviously.
Okay, I see the angle. Betting on a faster than expected fix. All right, my turn. How about this? Short the tariff impact.
Short the impact, meaning bet it won't be as bad as feared.
Exactly. Management guided $100 to $150 million net hit, mostly back half weighted. But remember how much they emphasized their diversification. Years in the making, China under 3% soon, no country over 25% target. They said they already mitigated over half the gross impact and are still looking for more ways.
So the bet is they're being conservative or they'll find more savings.
Or maybe policy shifts, right? They called it dynamic. What if their proven agility, combined with potential policy changes, means the actual net hit comes in well below that $100 million floor? The market might be overly focused on the high end of that range. This is a bet that their mitigation skills plus external factors lead to a positive surprise on that front later in the year. Again, purely speculative, betting on execution and maybe some luck.
Okay, two interesting, definitely speculative ideas there. And just one more time, these were hypothetical scenarios only.
Absolutely not recommendations. Investing involves risk.
Right.
Retail is complex. Talk to a professional.
Right. So recapping this deep dive, a strong Q1 overall, driven by Old Navy and Gap's momentum.
Ongoing foundational work at Banana Republic showing some progress, while Athleta remains the key area needing focused attention and fixing.
We saw strategic investments in their platform, tech, and culture underpinning this.
And a proactive approach to managing those potential tariff headwinds, heavily reliant on the supply chain diversification they've been working on for years.
They painted a picture of a company executing fairly well in key areas with financial strength despite the obvious external pressures.
Which leaves you with this final thought to chew on. Considering that dynamic retail landscape, that estimated tariff impact hitting mainly in the second half, and the fact they're up against a strong Q2 comparison from last year, can the momentum we're seeing in Old Navy and Gap, plus those mitigation plans, truly be enough to offset all these pressures and keep the company on track for its full-year growth targets?
Something to watch as the year unfolds. We hope this deep dive into the earnings call was useful.
Thanks for joining us.